Good morning and welcome to my 12th annual Entrepreneur and Investor Only Breakfast at Venture Atlanta. It's great to see so many familiar faces and so many new ones in the crowd this morning. Each year, we gather to discuss a topic that's at the forefront of innovation in the venture capital environment. But this year feels different. We're in the midst of a seismic shift, one that's not just another trend, but is a foundational change that is redefining how we build companies, how we work, and how we live. And that's why our theme this year is the Great Disruptor, AI and the opportunities from enterprise to consumer. To help us navigate this quickly evolving terrain, we've brought a phenomenal group of leaders together on stage. Moderating our discussion is David Excell, the visionary founder of Featurespace, whose company stands as a testament to enterprise AI success, and whose company, I'm proud to say, was scaled and exited right here in Atlanta. He's being joined by Garrard of TTV, whose relationship with Featurespace is a story of founder-investor partnership that we can all learn from. And we're delighted to have Vanessa Larco with us, a Georgia Tech grad and a vital bridge between the Bay Area and Atlanta, who after years at NEA is starting something new that I hope she can tell us more about this morning. And we're very excited to have Ryan Sanders from Mercato Partners, who brings a wealth of experience in investing in and supporting growth stage technology companies. I'd also like to give a special thanks to Scott Lapano at Texcro Ventures and Pete Franconi at Fulcrum Equity Partners, as well as Allison Neiman and the rest of the Venture Atlanta board for their partnership on this event. And before we dive into our discussion, I'm delighted to turn the microphone over to our friends at VIP Ventures, who are going to provide a brief overview of their State of Startups report. So with that, thank you very much for joining us. I hope you have an outstanding day.
Thank you. All right, thank you, Christian. Good morning, everybody, and welcome to Venture Atlanta. My name is Mark Flickinger. As Christian said, I work at VIP Ventures, GP at VIP Ventures. And I want to talk just a little bit about a report that we put out every year called the State of Startups in the Southeast. Just launched this morning. If you'd like to read it, you can hit the QR code on your table. Don't read it now, though, because we do have a great panel coming up. Every year, we look at 9 states in the Southeast, and we look at them in aggregate to see what trends are happening for both founders and investors in this space. And we like to see on an aggregate level, but then we go state by state and sort of see what everything is going on in the states, who's the most active, what exits we've had, if we had any unicorns, et cetera. I'll just take a brief kind of overview of these 4 points that I think are really interesting this year and kind of the headlines of what's in the report. I think some of this won't be a surprise to you. One thing is deal counts are down, so less deals are getting done, but average check size and overall capital is actually going up in the Southeast. So I think that kind of sees investors looking into companies that are a little bit more mature. Part of that is this rebalancing that we're seeing, whereas before we were sort of forced into investing more and more in seed stage companies, we're now back to roughly even in the Southeast. We're doing about a third of our deals in seed, third mid, and third growth stage companies. And as we're going to talk about here from an AI perspective, 2 of the big leads in the Southeast are information technology, which includes SaaS and healthcare businesses, mostly driven by the incorporation of AI in those 2 businesses. And then the last thing I would just say is that across the 9 states, all of them have various degrees of momentum. And it's interesting to dive in and kind of look state by state. So welcome to Venture Atlanta. We're really excited you're here. We have a great panel in front of us and an even better conference moving forward. Again, thanks to Venture Atlanta. We love being a sponsor, and we'll turn it over to Dave. Thank you.
Hello, everyone, and what a fantastic day we have here in Atlanta. It's great to see the sun shining and it's not too hot for us here under the tent. But to kick everything off, I thought we would start by a quick round of introductions from the panelists to introduce themselves and maybe what you're looking to get out of Venture Atlanta and why you're here today. So, Ryan, do you want to get us started?
Should I check? My name is Ryan Sanders. I'm with a growth fund based in Salt Lake City called Mercato Partners. I would describe us as an endeavor to find, fund, and support compelling businesses located outside of the capital concentrated cities. So I would say that is Atlanta. What I want out of Atlanta, or what I want, I guess, out of here, is to meet with enterprising founders, co-investors, and understand more about what makes this ecosystem tick.
Vanessa, over to you.
It's great to be back at Venture Atlanta. Hi, everyone. My name is Vanessa Larco. I am a co-founder and managing director of Premise Ventures. We just started the fund a couple months ago, but I was before that at NEA for almost 9 years. And I was a Georgia Tech grad, so it's great to come back to Atlanta. What we look for is we look for technical founders that have an eye for consumer behavior change. And I think at this time, where we are with AI, behaviors are changing both in enterprise and with consumers. And then check sizes for us, we're pre-seed seed. We're really excited to see the new crop of companies that are being founded. And what we're looking for out of Atlanta is reconnecting with old friends, co-investors, and meeting new founders.
Great. And Gardiner.
Yeah, hey, I'm Gardiner Garrard. I'm going to start with a question just to throw this thing into a different trajectory. How many here have kids that are like in preschool? Does anybody fucking remember how to make the kids stop talking and like pay attention to what you're doing?
Yeah.
You know, like where you do the clap, clap, clap thing? If whoever knows can remember that, can we do that for this crowd over here on the far right?
Yeah.
Just give them a little clap, clap, you know, like get them to pay attention. They paid a lot of money. We got like a $500,000 tent here. They're refrigerating this thing, pumping oxygen in, like we're in Vegas. Seriously. Clap, what is it? It's like a...
If you can hear me, clap once. If you can hear me, clap twice.
Wait for everyone to do something?
Yeah.
All right, well, maybe just do the buddy system and tell the person who's talking that they got a real special group of people up here, not including me, but they're going to learn a lot from Dave. I certainly have. I can't even remember the question. I was just so enamored with the, like, I really felt like we were back in, like, high school or something. Gardiner Garrard, I do venture capital, early stage. Been doing it, I don't know, 25 years, mostly stuff around fintech. There we go, it's getting so much better. And I know the people over here can't even see us, and I'm trying to look left and right, but they've got this, I think it's some kind of fusion lighting system up here that's like the sun. Like, it's very hard to see y'all over there, but anyway, looking forward to talking to all of you, and thanks for having us.
Thanks, Gardiner. Well, I probably wouldn't be here without you, so I've got a big thanks to say back. So maybe not everyone knows the story of Featurespace. So we started while I was studying at the University of Cambridge, and it was from a fundamental passion that I had about how could we teach algorithms, computers, to learn the behavior and profile as we interact with digital services. So I guess now we would probably be called an AI native business in terms of creating fundamental technology that we could then apply to understanding that behavior and looking to apply it in different areas. And as an early stage founder, one of the biggest challenges that we had was finding, well, what was the market where we could actually sell the technology to? But also, how could we find buyers that would actually understand what we were talking about when we were talking about things around detection rates, accuracies, ROC curves. And I remember in one of our first proposals that we submitted to one of our potential customers that ended up being one of the seed investors, it had formulas in it. So I don't think that was something that I would sort of recommend going forward. But we started in the online gaming area, so looking at computer games, trying to understand what was genuine behavior within those virtual environments versus where could we see robots playing and effectively have an unfair advantage in disrupting the sort of ecosystem of players. We then pivoted into thinking about how could we apply that into the gambling arena and identify people that were committing fraud in that particular industry. At the time, being in the UK, it was a high growth area. A lot of organisations were growing very quickly, and they were struggling with fraud because it was a great place for fraudsters to go and sort of learn their tricks before they then went into the financial services ecosystem. And that was probably our last pivot until we really found sort of the stride of where we could grow at Featurespace. And that's where I got introduced to you, Gardiner. Maybe you could describe when you came over to Cambridge, and we were probably 20, 25 people at the time, and what did you think when you were first introduced to the team?
Well, the very first thing was, holy shit, I got to fly to the UK next week. And I'm going to change it a little bit because a lot of what Dave said, I wasn't thinking at that technology level. it was more, we're just a very demand-oriented firm, meaning we really try to pay attention to the needs of the industry, and our industry happens to be financial services, and we happen to be sitting in the middle of the kind of worldwide headquarters for all things payments. And I think it's an interesting study, Featurespace, because for us it's kind of a down the middle, exactly how we want to do it every time. But yeah, you were an AI native, but I think what was so unique about Featurespace was they had the engine that Dave created at Cambridge with models, and yeah, you tried to apply it to gaming, but honestly, what were you doing when you built it originally? Like, what was it for?
It was just for the interest. It was the passion and discovery.
So if you're a scientist in here, then yeah, go after building the models and the actual infrastructure, but most people are really focused on the commercialization through the application of the engine. And what I found really cool about David and Featurespace was not only did they have the native AI, they were actually built the applications on top of their own technology. And when we met them, yeah, it was gaming, like video gaming. There was some gaming in the UK, like gambling, trying to identify problem behaviors. But the reason we bumped into one another is because somebody on your team ran into Cap One in the UK, and then they said, holy smokes, we could do this on a transaction by transaction basis to look at fraud on individuals' spending behavior. I remember when you showed me a gate of somebody walking, because I didn't know, I was like, what the hell are you talking about? And you were like, people have patterns, and you have your payment history has a pattern that can look outside your gate, and that's just behavioral analytics. So the reason we ended up investing candidly was Galen Jowers at TSYS had gotten a call from Cap One and saying, these guys have built this engine that we think we can build an application for fraud on credit card transactions. And I didn't really know the application well, but I knew Galen well, and I knew if he was going to fly over there to meet him and wanted me to go with him, that probably made sense. And then, I don't know, you had a couple other VC firms coming in. They had their own hats with their propellers on them, and they were talking all about machine learning and how cool it was. And Dave was like, yeah, I got that. I just need some help figuring out how to sell this shit to some payment people. And at the time, you were moving to Charlotte because they had a relationship with Ally Bank, and it's a great story for TTV because Knox Massey's in here, and literally the first investment Invest Georgia made was in our firm. And the first deal I did after they invested was Featurespace, and within 6 months, Dave moved to Atlanta and opened an office here. And I remember telling Casey Cagle that. I was like, hey man, you gave me some money and I invested, and then they moved here and they've hired like 100 engineers out of Georgia Tech. And I was like, it's not all because of y'all's investment. He's like, slow down, don't let a good story don't let the truth get in the way of a good story here. But I will tell the allocators in the room, the investors in the room, it matters when you allocate capital to people in this state. And it gives us tools to go out and meet people that are from Australia that are getting a PhD at Cambridge that end up living in Morningside, that are driving, and that's now the head of AI at Visa, in an office right behind us. And so anyway, I don't even remember the question, but it was a really good.
I don't think we should just ask him questions.
It was a really good experience leveraging what we have in Georgia internationally.
Yeah, and Georgia ended up being a fantastic home for us, like with the customer base that was here, starting at TSYS, but then all of the large fintechs that had their presence. And also, I would, coming from Cambridge and having a fantastic university to draw talent from, being close to Georgia Tech was just as important because we did hire a large number of engineers from the university, and that was transformational to our growth here in the US. And one of the things that you said was around being close to customers, and I think that was also another thing that was really important to our success and actually led to the acquisition from Visa. It was their customers that were demanding access to our technology and their distribution, which was sort of fundamental to sort of what made the entire thing successful. And maybe
just the last thing I want to say, just so people grasp this concept of this AI native versus, I don't know what you're calling the next one. I'd call it like application layer, but you got a word for it, I'm sure. Not agentic.
AI enabled, I think, is the
AI
term.
enabled. The thing that made Featurespace so interesting and have such a moat was they were building the large transaction models. Dave actually built the original kind of, instead of the LLM they were using, instead of language, they were using numbers and data, transaction data. And I think had we not sold to Visa, we were headed down the path of being an infrastructure company, at least at some level, selling out that engine to other people to build their own applications on. But 95% of the businesses that people will create are going to be application layer businesses or agentic, you know, when that matures a little more. But what I think was special about David was they actually built the technology that they built the application on top of, and I think that's really rare.
No, thank you. And I think one of the things that I now reflect back of going, if I was going to start a business again, and thinking about something, Gardiner, you told our team when you came and presented at one of our offsites around when we had the evolution of the internet maybe 25 years ago. And it wasn't necessarily the invention of the internet that generated the economy that we have today. It's all the businesses that transformed on top of that. And I guess I would turn it maybe over to you, Vanessa, to start with. If you think about what OpenAI and the big foundational AI platforms are doing today, the incredible, every day there seems to be a $100 billion investment that OpenAI is making in some chip company or fab company. How do you sort of see founders building a business that won't be overtaken or sort of captured by the investments that those large organizations are making?
Yeah, I'll start with my generation was when mobile came out. So I graduated from tech when the iPhone came out and there was no App Store yet. And I moved to the Bay Area 2 years later when the App Store was really starting to pick up and people were building mobile apps. And I remember having a couple of friends in venture saying, this mobile app thing, there's no IP here. It's not an infra, it's not database company, it's not telecom company. There's no patents. Like, this isn't venture fundable. These are little widgets or toys on a mobile device. And they were right, the initial mobile apps were just a port over of web app. Famously, Facebook made an HTML5 app and said, I'm not building a native app, this is stupid. So nobody took it seriously. But it turns out that this little phone had internet in your pocket, and it was an entirely new form factor because it also came with a camera and it came with a GPS. And so it took a couple years for people to figure out that there's entirely new use cases that you can build on this device, and you shouldn't port over the thing. I mean, it cost Mark $1 billion to buy Instagram. But then everyone caught on. I'm like, well, let's build entirely new applications. And you got Uber, and you got Lyft, and you got Airbnb, and you got DoorDash, and you got all these like entirely new things that came about. Then Apple started building its own flashlight app and its own filters in the camera, and everyone's like, oh no, Apple's going to build all the apps, we're all going to die.
I think there's a term for it, Sherlocking now, isn't it? Is what is often referred to, and everyone looks out at the next iOS release to see what new apps are going to come out.
Yeah, and then when cloud became a big deal, which was like not too long ago, which is crazy, I remember NEA being like, Zendesk, it's just built on AWS. There's no tech here. It's just a web app. Same thing is being said right now with OpenAI and they're like, oh, it's just a ChatGPT wrapper. It's not a real company. And we're seeing that that's not true. Where now everyone's saying, well, oh no, OpenAI is going to build it. We're all doomed. I also think that's not true. They will build some of it. They will clobber up some things, just like Amazon launched things and clobbered up companies. But they're not going to build everything. And not everything they build is going to be great. The last point I'll put to that is I specifically don't think OpenAI is going to build anything that touches real-world assets. Sorry, the folks on the left, it's really loud. Like, we can all hear you over here. Yeah, it's very distracting.
We've trained for like 20 years for this performance.
This is true.
Come
this is
on.
True. You can go outside.
Rock and roll.
It's really nice. Thank you. That's so much easier to think.
It is really echoing. And maybe y'all don't hear it, but it echoes really loud right here. It's like you're in one of those domes where everything that everyone says on the edge is like coming into your ears. So be quiet.
Or go outside. I get it. But no, I don't think OpenAI is going to build anything that touches the real world. So I don't think they're going to build Airbnb because I don't think they want to manage houses. I don't think they're going to build Instacart because I don't think they want to manage drivers and pickers. So there's these companies that are building real world connectors, and I think OpenAI wants to layer over the top of that. And so I think that it's not going to clobber everything. It's a very similar talk track that we had with mobile and with cloud. I think it'll run its course.
I think it's embracing the change. So as Featurespace, we selling to banks, they were very much on premise. They pivoted to cloud. They pivoted to mobile. We saw lots of changes in how payment infrastructure is. So you need to keep up with it. So I think that's one of the lessons. What about Ryan? What are you seeing from your portfolio?
I think it's the most dynamic environment that I've ever been in. And so I would say in some ways I'm jealous of the entrepreneurs who are just a little closer to it. Once upon a time, I would have said that capital was the differentiator. And I think to some extent, it was used as a weapon over the last 10 years. If you could raise more capital, you could outwin. And I think this proof, I don't know, a couple hundred people that are here, is to me proof that geographies, expertise, insights, connections still matter.
Yeah.
I remember coming, to Atlanta. I remember my first call with David Cummins at Pardot, trying to convince him to take my money, and we were one of the ones, like everyone else, that weren't successful. The first investment for me was in Silverpop with Bill and crew. And so I've watched this environment for 10 plus years, and I think it's as good as it's ever gotten. And yet I think my take is, like, it takes all of you being here. So I would say thank you to all the people who've put this on and caused a great group to come together. When I think about the question about what's different, or maybe what advice I would give, I would say stop trying to compete with OpenAI and Anthropic. Compete on a different, I would say compete on contexts, on contracts, and on control. There are things that are uniquely within your own unique advantage, and you don't have to be like everybody else. And I think to some extent everybody wants to be like OpenAI because of the value, because of the dollars that are there, and that's not your winning proposition. So I would say, like, maybe a counter thesis right now. I think that it's not just AI that is the war. I think it is the SaaS contract. It once was that SaaS companies were the most highly valuable because they were the easiest to underwrite. You could look out 3, 4, 5 years. You could underwrite cash flows. The public markets got it. The private markets understood it. It provided predictability and stability to the companies. I would say today, more often than not, we see procurement at the largest companies that are willing to push back on these multi-year contracts. Part of it because they know that AI is moving so fast. I'm not sure that they want to lock themselves in to something, but I would say the companies that are doing best, in my opinion, are those who find the time to value shrinking. I think we're going to see the SaaS contract destroyed, maybe in some cases, but it'll be destroyed by pricing, that it's about wins, successes, transactions. They'll pay the same amount. They might even pay more amount per year if you can prove it. So I think it's about shrinking the time to value. It's about creating ROI, and the companies that I see best are the ones that have taken the most dramatic movement inside of the time to value.
I'd agree with that. Where I think this actually puts Atlanta in a really good position, because with all the AI tools, with every AI SDR, with all this like email targeting, people are getting bombarded. And I think everyone's going to retreat back to the relationships they have that are in person, where you like trust the founder of the company. More it's going to rely, it's going to be less transactional, surprisingly, because we're going to flood all the transactional channels. And y'all are in a hub with amazing Fortune 500 companies that are buyers, and also in the hub of logistics tech, which understands consumers and their purchases better than anything else. So I actually think Atlanta is in a very good spot. And then I also think that Atlanta's been constrained by lack of capital. In Bay Area, people get a $10 million seed. I come to Atlanta and they're like, what? I was like, yeah, I was off a deck. They're like, what? I'm like, yeah, it's terrible. And that would give them an advantage, but now it doesn't. Because I have a company in my portfolio with 3 guys that built it. They have almost 2 million DAUs. 3-person company.
2 million?
2 million DAUs, 7 million monthly active users, 3 guys in the company. Everything is automated. They don't need any money. We got it at the seed and we're like, let it ride. But that's great for Atlanta, because you don't need to raise 10 million and you can build something really great because you can automate a lot of things. So the things that were holding it back, I think, are the things that are now going to propel it forward. So I'm bullish on the ecosystem here.
Yeah, it makes it much more accessible. So as a founder, capital was always really important, and making sure we're spending it right. And one of the exits that always fascinated me was Mahjong with Minecraft, where they exited to Microsoft. I think it was $2.5 billion, 160 million of operating profit with only 40 employees, so the massive amount of scale. And then I think you mentioned Instagram, 13 employees, $1 billion to Facebook. And for me, it's really, can AI create the next one-person company worth $1 billion? It feels like the technology is enabling that to happen. Maybe Gardiner, how are you seeing your founders utilize AI, and has it changed the business models that you've seen from the original investment to where they are today?
Well, it's hard to skip over that one-person billion-dollar company statement. I think directionally that makes a lot of sense. I think as a society we better get people buying into corporate America in one way or another to participate in this, because I do think a lot of the labor force is going to be disrupted and a lot of the value is going to accrue to the organizations that are solving problems. And the world's not short on problems. And I think this frenzy around AI and any technology really is just a matter of perspective. And where do you sit? What context do you have? And to me, the biggest and best anchor for breaking down a frenzy like this is sitting on top of the problem and really being wedded to it and committed to it. And if your life's mission, your company's mission is to solve a particular, hopefully very big problem that previous technologies have not adequately addressed or have left a lot to be desired, then you can break down these tools that are showing up. And I read recently, I didn't come up with this word, but I now love it, but it was a guy at OpenAI, the COO, and he was characterizing these enabling technologies and enabling AI as the substrate. And I looked it up, and that means it's a foundation on which, biological organism can grow. And so this AI today is really just your substrate, and you're building an organization on top of it. This is going to be trickier than previous substrates because this substrate is changing every damn day. It's not like the internet didn't change. I mean, you went from buying an airline ticket to watching a movie. It maybe took 10 years, but this substrate's changing daily. And the only way to maintain your balance as an organization, as a founder, is to have a true North Star on what the hell you're trying to solve for. Then, as these new solutions are showing up, you have the app, you know how to apply it in your particular observed event. But if you're chasing the changing substrate and trying to build organizations and organisms on top of each new method, you're just going to be caught up in the frenzy, and you're going to get lost on what your mission is. And so, again, I forget the question, but what was the question?
I guess, have you seen
This is like my stick. I just act like I don't remember the question, but I truly don't this time again.
Have you seen any of your founders or portfolio companies pivot with AI coming in?
Of course. So what I mean by that is like, geez, I mean, we did it Featurespace a little bit, but any of our companies, and particularly the vertical SaaS businesses, I mean, who's going to best get to you quickly with AI innovation right now? The people that have the distribution that you're already looking at. I mean, Microsoft Office is just going to be better, And so, yeah, if we have a company that is focused on helping families do better with their money and their parents and their kids, they're going to put AI inside that application. Yeah. If we've got a company that's doing vertical SaaS for waste management, they're going to put AI in there to automate the tools because, it's accessible. Yeah. And it's not that the individuals that are building it are the experts on AI. They're just experts on trying to figure out what's the best way to create automation and efficiencies. And hundreds of billions of dollars that you don't have to spend are going into this substrate.
I'm going to just challenge that for a second. I think the risk for companies that are Series B and C and D is, yes, they're putting it into their products and they're really, really thoughtful about it. But I've gotten multiple calls for those founders being like, I don't know what the AI best practices are to adopt to run my organizations. Do you guys have good consultants? I'm like, aren't you building AI? Yeah, we can build it, but like we're not using it in our day-to-day. And there's a really well-known founder, I'm not going to say who it is, in the Bay Area, and he IPO'd his company and then stepped off. As a joke, him and a buddy started an AI consulting company, and it was meant to be like an Onion article, and then they got real calls, and they were like, okay, we'll send a couple people to help you to figure out how to AI automate your internal processes at these like pre-IPO companies. And then they got more calls, and he's like, shit, I need to hire a real CEO for this. Like, this isn't a joke anymore. So I met the new CEO. He's like, this is bananas. I have like a Series B company that's willing to pay me boatloads of money to go in and help them figure out where to use AI. I'm like, that's a problem. Even in the Bay Area, where everyone's whatever, Mark Zuckerberg wannabe, they don't know where and how to adopt AI themselves in marketing. In customer support, everyone uses like Decagon Assembled, one of those. But in marketing, in ops, in HR, everyone's trying to figure out how do they become more efficient. And so I think the risk to companies who have already built out big teams and already have processes is not disrupting their internal processes quickly enough, and then having their cost structure impede their ability to be flexible on pricing. And I think then things start to slowly kind of unwind. So I think there is a threat to the mid to late stage companies.
I think one of the hardest spots to invest is where both of you are today. It used to be that if you got to $1 million, 5, and 10, there were these classic de-risk points where someone say like, yeah, capital's going to follow that. They've come faster than ever before. You're going to see this one person, $10 million ARR company. The risk is that there's no retention because they haven't gotten to the second year. There's no cohort, I would say, to put behind it. So, today when I think about companies and what they're doing, I would say risk and finance is a place that they've put AI, and they think about sort of contracts and fraud and governance. I think the second piece has really been sort of the sales aspect, as much about top of the funnel conversion metrics and understanding like who's the best prospect. I think today the very best place where it's being placed is inside of the customer success, and I would say like I'm advocating more often than now for the single metric that we should talk about the most is about usage. It's perhaps the best predictor of the retentive power that sits out there. And I'm watching some of the very best AI being placed and helping a team be able to understand how attached somebody is to a product, what the real value they're getting out of it. It helps them point them to customers at risk, customers where they can see more value, where they can upsell. So I think for me, the post-sales success is maybe the most important implementation of AI right now.
Yeah, I will say for folks that are pitching VCs and you're in the tens of millions of revenue, quality of revenue is now a new metric. Like we used to just say, get to 1 million, get to 10 million of ARR, get to 50 million ARR, and then these are like the multiples you'll get depending on your margins. Yeah. Now it's it depends. What is that ARR? Yeah. Who is that ARR from? How early is the contract? Who was the buyer? Was it the AI, a liaison person, or was it the actual like head of that department that made the purchase? But we, I think, learned a big lesson with Jasper AI. I don't know if everyone remembers that, but it was one of the first copywriters in AI, and it got valued at $1 billion very quickly because they got to 10 million in ARR in like a month, and then they got to 100 million. But it was all, when I used the product, it made you immediately pay for the full year up front. And so everyone's like, $60 full year, yeah, I'll do it. And then nobody renewed. And the revenue just imploded. And then all the VCs were like, oh, wait a second, not all revenue is created equal. And so as part of the diligence now for most of the multi-stage firms, there is a line item in their memo that has to describe the quality of your revenue. Mm-hmm. And it's exactly to try to get at the risk of this thing not being foundational to these teams.
Can I add one more thing to this?
Go for it. Yeah.
This is something that I think the importance of another metric that's gone up, in my opinion, is gross margin. And maybe this is a belief that I have that I'd be interested in their take. I think the reason the gross margin has gone up is because it's customer directed. They decide the ease with which they're found and supported, and you don't control it, to some extent. They control it. I think you can do things that build toward it. I've always thought of the net income line as managed by an excellent management team, and that's certainly who we back. But I would put more weight today on the gross margin because I think it's your superpower in good and bad markets. It's your reinvestment capital that you get from a customer today. And I think, even before you get to that first year retention, I think a really low gross margin, you've given your opportunity to everybody else. I would track the gross margin, and I would track the usability metrics.
There's a lot of debate around gross margin right now in the Bay Area. Gross margin, if it's lower than we would want, a lot of the founders are like, yeah, we just built it on OpenAI to see if people will adopt it. And then if it does get a lot of adoption, we're just going to switch to an open source model or to a small LLM, or we're going to just optimize how we prompt and use OpenAI. So we'll bring these costs down, but first, we just want to get out there with the highest quality product. And that has tended to be true. So I will say, like, you want to be cognizant. We did have a founder that lit it up and then had so much usage, surprisingly, and we were all happy. And then he's like, I'm gonna need to raise $1 million like tomorrow because I owe $400,000 to OpenAI because I didn't gate it. I didn't think it was gonna blow up. I didn't think it was gonna go viral. And now I don't have any money in the bank. And we're like, shit. And we're like, okay, do you know how you're gonna optimize this? He's like, no, I didn't think this was gonna happen. We're like, well, we can't shut down the app. And you should have had, like, in your back pocket, ready to switch to something cheaper or to send it an optimization. And there's a lot of stories like this, like Cursor. There's a bunch of these. Like,
sounds like a good problem to have.
It's a good problem to have, but then you're on the hook because you have to fundraise immediately, and investors know that, and you'll get penalized. But there is this argument of, like, worry about gross margins if there's market pull. Don't worry about gross margins if nobody wants your product.
Yeah, it's the problem with being able to scale too quickly is the cost can rank up. And one of the interesting things I've seen is pricing models change to price per outcome, especially when we're looking at agentic experiences. And can the agent actually resolve the customer's problem from a customer success problem? Are you seeing pricing models shift as well?
Only in customer support. And then it gets really wonky beyond that. Because if you're saying we're going to improve your sales by 30%, or we're going to do blah, blah, blah because our AI is so good, it's really easy to price it the first year. But what's your second year, right? If the first year you already made the improvement, how do you get the price savings or whatever on the second and third and fourth year? So pricing models are very fluid right now. It looks like it's going to be a hybrid of SaaS, like a platform fee, and then some usage fee on top. But it's the first time I've seen people innovate on pricing model.
I agree with this. I think one of the companies that I'm paying attention to is Sierra, which is Brett Taylor's new company, and their pricing model is on the outcome from an agentic standpoint. And I think there's a really interesting, almost sort of head nod to what matters most to the people who are signing checks, and that's what procurement's paying attention to, which is like, did it drive ROI? And there's going to be a lot of argument about did you change my sales efficiency by 20% or 30%? But if someone can point to, a human didn't have to get involved and an agent did all of the work, and that's what we should pay on the outcome, there's a lot of alignment right there. So I would say they're leading the pack in my mind.
Yeah, but it's customer support.
Yeah.
Customer support is really easy because it's a ticket. You resolve the ticket. But, like, if you do AI for product management, what is your measure? Like, the PM was more productive, they wrote more specs? Like, what's the measure on that? So it's very clear with customer support, and that's the one everyone talks about. But I challenge them, like, okay, let's talk about product management. Engineering, that, like, we know Cursor supercharges engineers. Is it lines of code that get written a weekend? Like, that's probably not the metric you want. So it's a little squishier. And if you say, well, we saved you 10 headcount on engineering, okay, that's great for the first year, but now that's your new baseline. What do you charge on that next year? And so I think for customer support, that's the example people love because it's very clear. But for everything else, it's squishy.
And we've had that problem, Gardiner. I think we often talked about how do we price for value, and it was very easy to do. Yeah, very easy on year one, but year two it was you've already saved them $100 million of fraud. Do you need to save them another $100 million of fraud the next year? So it was a challenge.
Well, the other challenge is the industry you're selling into is. They're not to quote Laney over here, they're not the move fast, break thing crowd, it's banks. And the reality is they already had a solution in place with the Falcon system, and it's been used for decades. It doesn't work perfect, as we all know, when our credit card gets turned down just because we went to a foreign country and forgot to call the bank. It's still us. And that's what they call false positives. But anyway,
Yeah, and I was going to
they-
say that selling at Featurespace, we were selling to banks. They had a model risk management team, and often a lot
But-
of our sales process was about showing how safe our technology was.
But recall, the best we could get initially was a belt and suspenders. They wanted to add us, but they wouldn't replace what they already had. And that didn't have anything to do with functionality. That had to do with trust and fear. And, it's not broken. This is better, 13 to 1 to 3 to 1, fraud's down, but we had to price incrementally against, we were charging 10, 20% to do 3 times as good because they weren't willing to get rid of the old system. And that's another thing you faced with when you have an inertia in an industry. I mean, Christ almighty, how long do we have to have these telephone poles with all these wires hanging around? It just looks awful everywhere you go. But what are you going to do? It's been there so long, they can't afford to go bury it or to switch it. And that's what you face a lot of times in large industries that have regulators, and their entire business is built on protecting your identity and your money. And so, if the question is, how do you know when they're ready to move, is you wait and ask them. And when they say they're ready, I don't have to try to figure out why they're slow. I just have to be aware of it and figure out when they're ready. And I think we got lucky with Cap One because they're just a very progressive, data-oriented institution.
Yeah, it's finding that classic early adopter customer that's willing to take that risk. To change the conversation a little bit, there's been a few examples, like Air Canada last year got in trouble for their bot making recommendations to a customer, which ended up being incorrect. We had, I think, Accenture last week had to return money back to the Australian government after they used ChatGPT to generate one of the reports that was full of errors. Have you seen companies move too fast without thinking about the consequences of making something go wrong? And how do you think about that from looking at quality and the risk of the product that they're building? Maybe Ryan, start with you.
Unfortunately, I don't have the inside portfolio example of a fraud or something that's gone wrong. One of the things that one of our portfolio companies is a company called Lambda, and Lambda is hopefully for most of the builders in here one of your best friends. They provide GPU compute. They've made the move 3 times. They moved from hardware on-prem CapEx controlled to a cloud, a lightweight, a developer plane. Now today into the hyperscale environment. And so I would say the thing that has mattered the most and where we haven't gotten something wrong is on unit economics. That's mattered maybe most, and the AI side of an ability to understand where to put the next dollar. We haven't had systems yet that have told us where that isn't. There's no lack of customer acquisition opportunity. So I would say that sits out there right now. But you're asking about where's the mistake? Where's the mistake been? I don't know if I have a great example. I think most of these companies, today I would say they're paying attention to the right signals.
That's great. What about you, Vanessa? Have you seen?
We haven't uncovered, nothing's really blown up yet, knock on wood. But we do bring it up of hey, how are we testing? It's really hard to test against it. But the risk is, and I'm in the Bay Area, so everybody's moving fast and breaking things left and right, which is why I don't invest in healthcare. It's we break things and your AI companion's not awake today, the world's not going to end, but I don't want my medical device, making errors. So, but we bring it up, and the truth is founders are I can't slow down. Even if I wanted to spend the time to figure out if this type of error is possible, we don't have time. And our competitors aren't doing it. So we are in the phase right now, unfortunately, where it is the Wild Wild West and people are moving as fast as possible. And there have been already big implications, but they haven't been big enough and they haven't been pervasive enough. And in Silicon Valley, we're don't regulate us because the Chinese aren't getting regulated, so you can't regulate us because we can't compete with China. It's okay, fine, but we are going to do something eventually that's so bad that everyone's going to be oh, yeah, let's totally regulate this. And then we're going to be upset that we're like deeply regulated.
And we are starting to see it with, I think, like age gating a lot of the access to the ChatGPTs and things like that.
But it's not real, and they don't really care because they just want data. But California passed something. We'll see what happens. Everyone's crying about it.
Like one of the things that I was thinking about, so if I thought about it maybe differently, like where does a startup have an edge versus where does an incumbent have an edge? And I think the incumbents today still have an edge when it is regulated and longitudinal data. I think there are certain places that people still don't want to touch for the risk of error. And so like the reason I was talking about Lambda is that there have been some places where we haven't put certain systems because we didn't want to ingest and take on somebody's regulated data, today, so we haven't had the mistake. I think startups today have their edge is on workflow in places where they can check in perhaps 12 times and they can reduce like the time to verified value, faster than anybody else. But I would say there are very few companies that are willing to go into places of like high regulation because the sort of the price for winning is not as high as the cost for impairment or losing.
Yeah, no, and I just got back from India where I attended Global FinTech Festival that had 100,000 people attending, so it was a huge conference. And one of the interesting challenges there was being regulated by the Indian government is looking at everything being onshore, which makes it very different working for an American-first organization in the current geopolitics. I think we've only got a few minutes left before we go to questions, so I was just going to go a quick fire question for all of you. So I guess what's an AI tool that you've churned from and why wasn't it sticky? And maybe what lesson can the audience learn from that?
For me, all of them. Like there are very few that have made their way into like a permanent. And then in fact, like my test today for AI fluency for everybody would be to look at your phone. And if there hasn't been an AI tool that is new onto your front page, I think you're falling behind. I think this is an era about experimentation more than it is standardization. So I would say for me, like I've churned from all of them.
Oh no, I use a lot. Well, I'm building a new firm, and so I'm automating everything because I don't want to hire anyone for a while. I churned recently off of Motion, and I also churned off of Zapier, and I'm going to try a couple other ones. My Zapier integrations kept breaking. Motion got it wrong more often than right, so I was spending more time correcting the errors than I was benefiting from it. But outside of that, like if I don't have Claude Code, I die.
Like for me, I probably have 7 LLMs that I use, and I use them for different tasks, different times, and different weights, and that changes. Like even on like where I believe that they sit.
What about yourself, Gardiner?
Well, I mean, I'm not. There's nothing. I mean, I use it. But it's like my dog ate an avocado seed. What the hell do I do? I mean, like, and that really happened. And amazingly, they immediately said, they gave me the name of the vet, what time they were open, where to go, and the fact that it was toxic. And so things like that, when there are questions that I don't know the answer to, I ask AI, and I'm quite fascinated with it. Even creative stuff, when I'm trying to kind of get curious about something and stimulate some ideas. My daughter was doing some music festivals and we were talking and I was trying to write down like what I thought the best plan of action would be, and I was like, what are we doing? I was like, give me the computer. And I just typed in plan to operationally set up a venue for a music festival, and it was unbelievable. It was unbelievable. It was like just this beautifully written. So that's where I use it. I'm just using it when I have a problem and I don't know the answer. And I know I'm beating a dead horse here on this problem thing, but most of our companies using AI today are using it internally to solve their own problems right now. Most of them selling into the marketplace are not putting critical elements in the hands of AI yet as it relates to their customers, particularly in financial services. There are features in there that are AI enhanced. Internally, they got 200 people in a call center. Yeah, they got an agent right now listening to every damn phone call, and they think in a year, the agent can do any voice, any accent, any language, and will handle all 200 call center calls. And I believe it. And they're testing it periodically. They'll let it slide in there and take a call. But, I mean, we can't even imagine what the applications are yet. I mean, one of our venture partners said the Match.com CEO last week was saying
They're creating AI avatars on more detailed profiles, and you can send your avatar out on first dates to see how it goes. And then you come back, and I'm like, that sounds crazy, but I remember I got out of college when Netscape came out, not when smartphones came out. And the idea you were going to meet a wife or a spouse or a boyfriend or a girlfriend online seemed cuckoo to me. The idea you're going to let somebody else stay in your house seemed cuckoo to me. The idea you're going to drive somebody around in a car was crazy. I just saw 5 people get out of a car that didn't have a driver, and I've ridden in them, they're great. But that's AI at its ultimate regulatory, and they're showing it's, 20x safer.
Yeah. I'm interested in when I see my first deck where someone puts AI as their co-founder when they walk in. This is the solopreneur, but I think like what they're going to teach it is to have like a multiple personality disorder, and it's okay for the AI to be their very best creative friend. So like solopreneur with an AI as a co-founder.
I think they're going to, as they enhance memory on these agents, I'll read a lot of sci-fi, and a lot of this stuff is showing up. And I do think, I don't know if y'all saw that movie, Her, but I think that an agent like that follows you around and listens to you, which they're already doing with, what stuff in your, I'm joking, I'm not a conspiracy theorist, but I do think they listen. But the AI is gonna have a personality that resonates for you. I mean, I'm watching this show, Slow Horses. One of the computer guys is dating a bot. He doesn't even know it.
No, but it still comes back to me, it's like building a team, and that's one of the things that I really enjoyed about building Featurespace was the team around and creating, and I think like that's still important, and also selling to customers, understanding what those problems are. So I think we've only got a few minutes left, so I was going to open it up to see if there's any questions from the audience before we wrap it up. Do we have, we've got a mic coming over, so there's a question over there.
Hello, I'm Diamond. I am with Catalyst by Wellstar. I'm a VC there. My background's in product management, and so, that's me. My question is for you, Vanessa. Yep. So, given that you are building a firm as a VC, we know that there's a lot of early stage startups that are trying to leverage AI for platform work, for deal sourcing, for even full diligence. And so, I'm curious for you, what is actually the value add in AI from a VC standpoint when you think about your firm, given that you have to be a little bit more conservative with capital when you think about Fund 1?
Oh, everywhere. We think about it like C, pick, win, support. On the C is the sourcing piece. Building an agent that goes through my email, and when I get a cold inbound or I get referred to a founder, it looks them up on LinkedIn, it looks up the website of the company, it reads the email, and it tells me the probability that I want to accept the meeting or not. So that helps me just filter because I get so much inbound. So being able to filter it out quickly and see like what are the meetings I need to take is very helpful. I use Granola for note taking. I tell people they're being recorded. Granola then gives me my follow-up to-dos. I take all my to-dos from all the meetings. It creates my task list. From there, diligence, when we're looking at a company, I upload all of the memos of companies we did and didn't do into Claude. I also upload the data room. I upload our template for our memo. It pre-writes everything. We go through it. The most important part has been public comps and competitive landscape. From there, it pulls out like the margin tables, the predict, like all of it. I look through it. 60% of it is pretty good, 40% sucks. Then the 40% I rewrite and do my work myself. But I get to focus on the things that like really matter, and the stuff that's pretty straightforward and not differentiated thinking handles it for me. And then I review all my lawyers' work because surprisingly, so our sorry lawyers in the room, they make mistakes. So when they send me the term sheet and it doesn't have the terms that I want in it, it will catch it for me. And then as we negotiate terms, I will ask ChatGPT, like, what are the implications of taking out this voting blocker, whatever, so I don't rack up lawyer hours. Again, sorry, lawyers. And then once we onboard the company into the portfolio, we do a lot of events and help them recruit. And so we use it a lot for our event planning, both sourcing attendees, following up with them, setting up the vendors. So I have a lot of my day automated, and that's how we're able to build a VC. We have 12 investments while we're fundraising, while we're building our tech stack, and it's just 2 of us. And we have kids and a family and stuff. Like, I have a life, I swear.
Well, it sounds like you've been able to outsource a lot of that to the AI to get done. Any other questions from?
Great. Thank you.
I'm going to say one more thing.
Of course.
I think it's important that we got leaders in here. And we're all deep into this capitalism right now, and I love it. It's a great game. It's super fun. And we're about to be on a platform where it's going to be easier than ever, in my opinion, to make a lot of money, you know, just preying off the disruption and the change. But at the end of the day, everything we've created in our society is about human beings. I mean, it's about how we hold the society together, how we hold civilization together, how we make lives better, and how we measure the bar on what kind of the lowest denominators. And the democratization opportunities with AI is incredible, but I just think that people in this room have a lot of responsibility that they don't fully understand in terms of the judging the ethics and the risk of AI. I mean, well, shit, you know, it's a think globally, act locally thing. I mean, do the right thing inside the organizations and teach your kids some damn EQ and not just the fact that it's all about machines. People individually need to work on their own entrepreneurial efforts, which is more rooted in self-confidence, you know, curiosity, optimism. It's not ones and zeros and understanding computer science. These tools are going to be here, but how we use these tools, honestly, it starts with where the money goes and what the entrepreneurs that are building these companies do. And I love the idea of $1 billion one-person company, but I like the idea of that company doing something for society that, you know, makes a difference. But I just say that because sometimes I think we lose our way in the venture capital industry, just having leaders that care about other people. And I don't know, I can't help it. I needed to say it to this group because this AI is different than anything we've seen before.
Well said, and I think that was our mission, to make the world a safer place to transact. So I guess on that, we'll thank you to the panelists for spending your time with us this morning, and I think hand back to you, Chris.
Yeah, thank you all. Just a huge big round of applause for the panelists and our moderator. Thank you, Christian, for your sponsorship of this panel every year. Pete, who was a huge part of putting this together with Fulcrum. And for me, Scott, with TechSquare Ventures, thank you all. Have a great conference. Enjoy your day.